So hello everyone. I just want to finish up the chapter 15 slides, and because of a lot of conflicts of interest, especially with accounting, and banking, the Sarbanes-Oxley Act of 2002 came about, and this was mostly for all the accounting scandals. So basically, they increased supervisory and oversight to monitor and prevent conflicts of interest, and it helped a lot, but it cost companies tremendous amount of money to implement this. So it basically the main goal was to prevent investment banks from not exploiting conflicts of interest, and the basically the managers had to sign the accounting statements and swear by them under penalty of law if they didn't. So banks had to sever the links between research and securities underwriting, and basically it banned spinning of telling stories about different things, and there was big fines that were levied, and investment banks had to do a lot of make a lot of things public from their analysts. And here's the information about the research firms. Uh, Whoops, hold on. Uh, and that would provide research to their brokerage customers. So this was all part of the Sarbanes-Oxley Act. After all the accounting scandals that went on with WorldCom and Tyco, and you should read up on some of them. They're quite interesting. They're quite interesting. So I mean, they're somewhat important to know about. And the whole Sarbanes-Oxley Act is quite long, and it's something you should be aware of. So Dodd Frank came out after the 2008 scandals, right? The mortgage crisis that came out in 2010. So that was the other main act, and they created put a lot of pressure on the banks with compliance, and it required the SEC to prevent issuers of asset-backed securities from choosing their own credit rating agency. So this was one of the big things to prevent Moody's and Standard and Poor's from working for them and at the same time rating their securities. So there was a lot of different things that came up with regard to all this. Okay, so basically, conflicts of interest are always a problem in the financial industry. And it all comes down to really reliable information and truthful information for all, and that's the big thing: the amount of positive, truthful information. And basically, the penalizing the financial service firm and promote new institutional means, and basically, transparency is the magic word here. You got to have transparency and good information that's available to all. Okay, and not have separate a lot of the services from each other. And this is important, the supervisory oversight, which is what Dodd Frank and did with Sarbanes Oxley. And here's what I just said: separation of functions. Right, you had to have functions separated. So, Sarbanes Oxley um, basically provided for more information. You see what it says here. This is what I mentioned: the CEO and the CFO of a firm to certify the financial statements and disclosure of the firm. So they had to make sure they signed those statements to make sure, and they had to swear by them. And you can see it says here, was not cheap. The cost of compliance was extremely, and it's to this day, it's extremely expensive for companies. So that's pretty much that's pretty much it. And I'm going to attach a couple things to this now. So you can see here's the main point right here. The two main points. Increased supervisory oversight was a key feature of both Sarbanes-Oxley and Dodd-Frank. Right? I mean, that's what you really needed, supervisory oversight. And it separated a lot of functions with regard to information. So I'll be adding more stuff to this. Alrighty, that's about it for this chapter.
Universal banking. A universal bank is made up of a number of distinct elements. The first is commercial banking, concerned with the borrowing and lending of money. The second is investment banking, which is concerned with helping companies access the equity and debt capital markets. The third element is market making, providing derivatives to clients to help them manage risk, broking, the matching of buyers and sellers, and prime brokerage, which involves sophisticated trading systems to hedge fund managers. The fourth element is bank assurance, asset management, also known as investment management, and the provision of pension insurance services. The final section is custody. This is the deep back office of a bank, ensuring that trades are matched and settled, and keeping a register of who owns what at the end of the day. So let's look at commercial banking in a bit more detail. Arthur has just been paid. Arthur deposits his money with the bank. As the money is transferred to the bank, so the amount will appear on the bank's balance sheet as a liability. So Arthur has deposited his money in the bank. But while he may think in terms of deposit, he has in fact lent his money to the bank. So what does the bank do with that money? It lends it to Ben, who uses the money to buy a house. As the money is lent to Ben, so Ben will appear on the bank's balance sheet as an asset. So the bank will pay Arthur, for example, 3% to borrow the money from him, and will charge Ben, for example, 6% to borrow the money from the bank. The difference between the rate at which the bank borrows money, in this case 3%, and lends money, 6%, is known as the net interest income. This is in effect the gross profit for the commercial bank. The bank can also borrow additional funds to lend out by issuing bonds. Again, as the money is lent to the bank, then, just like Arthur, these will appear on the balance sheet as a liability. Banks can also borrow and lend to and from each other. And that is essentially what commercial banks do. As well as lending to individuals to buy houses, banks can also lend to companies. Sometimes companies will use these funds to buy other companies. For example, they will use the loans to fund acquisitions. Banks can also facilitate trade finance. If Arthur is in the UK and wants to buy a container of plastic ducks from Charlie in India, and then Arthur may be reluctant to pay for the ducks until they arrive, and Ben may be unwilling to ship the ducks until he is paid. Essentially, the bank can act as a middleman and facilitate this trade through trade finance. If Ben wants to borrow 100,000 from the bank, then this may not be a problem. But if Ben wants to borrow 100 million, then the bank may need to get a group of banks together to lend the money. This is called syndicated lending. If Ben wants to borrow a significant amount of money to purchase an asset, such as an oil rig, then the bank might choose to buy the asset directly and so secure the loan on that asset, thus reducing the risk to the bank associated with the loan. And this prevents Ben from borrowing the money to buy an asset and then finding that he uses the loan for something else. And finally, if Ben wants to build a significant project, such as an airport or shipping port, again, the bank can use project finance to fund the initiative. Here, the bank lends the money to the project rather than to Ben, and the revenues from the project are used to repay the bank. Like asset finance, this is a way of reducing the risk associated with significant loans. So now let's look at investment banks. Investment banks provide access for their clients to the debt and equity capital markets, flotation on the stock market, and issuing bonds on the bond markets. Corporate finance is primarily concerned with advising clients on mergers and acquisitions and assisting with how these deals might be financed, borrowing money via acquisition finance or issuing debt and equity. The existence of the primary market, where companies issue shares and debt for the first time, will only operate with the existence of the secondary market. I will only buy a share in your company if I believe that I can easily sell that share. Investment banks therefore have a concern with the function of the secondary markets and thus become market makers. Principal finance is where banks take a stake in the deals on which they are working, essentially betting the bank's own money. Investment banks also provide their clients with derivative services, acting as the counterparty to clients who are looking to use derivatives to manage risk or to trade. Banks will usually offset these positions with other clients or banks in the market. Banks also provide broking services, matching buyers and sellers in the market and thus ensuring the liquidity of the secondary markets. Sometimes banks cannot find a buyer at the exact time that the client wishes to sell, so the bank will purchase a security with a view to offloading it at a later date, hence the existence of an equity sales team in banks, this being a form of short-term proprietary trading. Asset management involves looking after and investing vast sums of money. Pension funds and insurance companies are major contributors of capital to the markets, and fund managers will help to ensure that these funds are invested in the most lucrative areas. Custody is the deep back office, which ensures that all trades are matched and settled, disputed trades are sorted out, and registers of share and bondholders are all kept up to date. Important, especially when a company pays a dividend to the shareholder or a coupon payment on a bond. And so we can see how the universal banking model aims to provide a full suite of services to their clients, from depositing and lending money to accessing the capital provided by pension funds and insurance companies, and ensuring the liquidity in the markets to keep the clients trading. Back in the 1920s, the distinction between commercial banks and investment banks was not so distinct. Commercial banks were allowed to use depositors' money to buy shares as well as to make loans. This was all well and good when share prices were rising, as they were in the 1920s, but in 1929, in the Wall Street crash, share prices plummeted. This meant that banks were unable to repay their depositors, resulting in a run on the banks, causing banks to go bust and plunging the USA into the Great Depression. And the rest, as they say, is history. In order to prevent this happening again, the commercial banks were separated from the investment banks. The Glass-Steagall Act was introduced in the early 1930s. This separated commercial banks from investment banks, effectively saying that banks could either take depositors' money and use that money to make loans, or they could assist their clients in accessing the debt and equity capital markets, but not both. In 1999, after 70 years of relative financial calm, the Glass-Steagall Act was repealed. This allowed large commercial banks such as Chase Manhattan, the largest commercial bank in the USA at the time, to merge with JP Morgan, a major investment bank, to create JP Morgan Chase & Co. And that is the universal banking model.
Fraud is the intentional misrepresentation of facts which result in harm or detriment to others. Accounting fraud is a billion-dollar problem. Some of the largest accounting frauds over the past 15 years include Waste Management and Health South reporting fake revenues in excess of $1.5 billion. Overstating revenues isn't the only way to commit accounting fraud. Enron hid billions of dollars of liabilities off its balance sheet, thereby understating debts and related expenses. Its bankruptcy cost shareholders over $74 billion. Lehman Brothers combined the two ideas and recorded liabilities as revenues to the tune of nearly $50 billion. Think about that journal entry. Instead of crediting a liability, they credited a revenue. Some of you may have accidentally done that on one of the assignments. Now think about that error in this context. Overstating assets is another way to commit accounting fraud. WorldCom recorded about $11 billion in expenses as assets. Think about that journal entry. Instead of debiting an expense, they just debited an asset. There are two broad categories of accounting fraud. The first rarely makes national news because the amounts could be quite small, although not always. We call this misappropriation of assets, and it's basically stealing. You can see some of the common examples on the slide. The second category is fraudulent financial reporting. The companies earlier were examples of this. Regardless of the type of fraud, most have three elements in place, which we call the fraud triangle. Opportunity. Does a person or group of people have access to commit fraud? Pressure. Are there pressures, either personal financial pressures or market pressures, that cause people to act desperately? And rationalization. Does a person or group rationalize that what they're doing is okay? Where these three items are present, fraud is more likely to be committed. The Sarbanes-Oxley Act of 2002, which is more commonly called SOX, it is a bill and it contains 11 sections, and it was enacted in a reaction to a number of the corporate accounting scandals, including Enron and WorldCom. It applies to publicly traded U.S. companies. It requires them to maintain a system of internal controls. Corporate executives and board of directors must ensure that these controls are reliable and effective. Independent outside auditors must attest to the adequacy of the internal control systems. And Sarbanes-Oxley created the Public Company Accounting Oversight Board, which we'll talk about in a second. And finally, it created stiff penalties for violators, including what could be 20 to 25 years in prison. The Public Company Accounting Oversight Board is a private sector nonprofit corporation that oversees the audits of public companies and other issuers in order to protect the interests of investors and further public interest in the preparation of informative, accurate, and independent audit reports. And that concludes this brief overview of fraud and the Sarbanes-Oxley Act.